Scott Martin is here, Kingsview Asset Management, Gary Calpon, Calpon Capital Management, both geniuses and both here to weigh in. Scott, to you first on what you made of the jobs report and kind of the tentative response we saw from a market that's not technically open, but liking what it saw.
Yes, good report, Neil. Right down the middle of the fairway, as we're seeing at the Masters these days, or at least I was when I was kind of flipping back between the report, the reaction, and then the golf. Because, look, the market is in that mood, as you mentioned, to kind of, I think, take things, say, a little bit better these days than it had been, because things are becoming a little bit more predictable, certainly along the lines of inflation, say, topping out or leveling off, and the Federal Reserve, depending on who you listen to, whether it's Jim Bullard or Loretta Meister this week, looking at kind of ending this rate hike pilgrimage that they've been on for what seems like forever now. So as long as these reports come in, as you mentioned, right along the lines of expectations, or in some cases with wage growth a little better than expectation, I think you have a reality going forward where the Fed steps out of the way and the market can take over here and go up.
You know, there's a flip to that, though, Scott, and maybe I can explore with Gary, that given the inherent job strength, the Fed has wiggle room, if it wanted to go ahead and raise rates again in May. What do you think?
I think the Fed is watching these job numbers, and they continue to be strong. I think the Fed's got another quarter point in it. But, Neil, the 10-year yield is down at 3.4%. So I think they got room to actually cut. My biggest worry and why I'm wary is what the markets are doing. The 3-month Treasury bills at 5%. The inversion is like the worst I have seen pretty much in history, and very often presages worry. And I just have to add, in the last couple of weeks, the markets went after everything economically sensitive, from Caterpillar and Deere to so many other stocks in the industrials. I mean, they really crumbled. And the best stocks in the market over the last couple of weeks are the food, drug, beverages, and utilities, the most offensive recession-resistant areas. So I am wary on the economy right here. I am wary about a peak in the job market and a peak in the economy. I hope I am wrong.
You know, it's interesting when you look at the breakdown of the report and where the jobs are gaining. No surprise, you know, Scott, in the latest period, leisure, hospitality, something in Gary's neck of the woods he's used to seeing in the Orlando area with all the amusement parks and destination sites. So not a surprise that would increase, right, over 72,000. But that momentum is beginning to slow a little bit. And, you know, a gain is a gain, I grant you. But that's been the ringleader, and now it's not as much. What do you make of that?
It has been the ringleader, Neil. In some cases, I think a lot stronger of a ringleader, or better ringleader than we expected along the way, and we got better data in leisure and hospitality and spending than we thought. The craziest thing, though, for me, besides Gary Kay going to Disney World every day as he does, as I wish I could do, frankly, did I just hear him talk or advocate maybe easy money from the Federal Reserve? I mean, Fox News alert here. It's shocking to think about this, Neil, but that's the other point. And Gary Kay is right, and if he's on board, I'm on board. If there is a slowdown coming, say in housing, as you mentioned with the consumer, bank lending, the Fed does have some wiggle room, in fact, quite a bit here, I believe, to start cutting or start getting easy again, which probably does support market prices here, at least to be steady, but possibly to go up in the future, because the market, as we all know, loves free and easy money from the Fed and or the Treasury.
You know, and Gary, you always get sick of this when I do mention where you are in Orlando, but that is sort of like the microcosm of this, you know, hospitality and leisure juggernaut. And I'm wondering what you're seeing there, because I've always argued, you know, when you look at the economy in the aggregate, we've got plenty of problems. The banking thing, don't get me started, and that we're not maybe over that. But the one thing you'd always go back on is job gains that we didn't see during the Carter period with stagflation and all the rest. And we still see people freely spending on those very pricey Disney tickets and Universal tickets and packed restaurants that you've alluded to. Is the consumer going to remain that resilient? What do you see happening?
Well, it better. The consumer is about 70% of the economy. And as I've said to you, Neil, two things that are sticking out for me is savings rates are plunging and credit card usage is skyrocketing. I don't know how long that can last. Now, if you use Central Florida as an example, it's still going great guns. I fly every week, and all I can tell you is the adults wear mouse ears going in and out. And I can tell you this weekend, Disney World, you can't get in unless your last name is Cavuto. It is sold out. So business is very good. Business is very brisk here. 75 million people show up every year, 75 billion into the economy. So that's going great guns. But to me, I just watch the job market. I watch the consumer. If we lose that, I think we have a fragile, debt-laden economy. Let's hope they continue to spend like crazy.
All right, we just don't know. I do know that as soon as you mentioned my name, though, Goofy popped up in the video there. I don't know whether that was deliberate, by my tech staff. Gentlemen, hope you have a wonderful, peaceful weekend. Great seeing you again.
You too, Neil. Thank you.